Okay, let's unpack this. 43%.
Wow.
That's the combined chunk of the global economy that the U.S. and China represent right now. It's huge.
That's massive.
And if you think about all the stuff that gets made around the world, the cars, the gadgets, everything, almost half of it rolled off factory lines in those two countries just last year.
Yeah.
Numbers that massive tell you instantly why what we're about to dive into is so crucial for understanding the world today.
Absolutely. Today, we're taking a really comprehensive look at the economic and geopolitical consequences of this ongoing trade friction between China and the United States.
Wow.
We've got a range of in-depth analyses here.
Mhm.
And our goal is to really get beyond the day-to-day headlines and understand the fundamental economic and strategic forces at play for you.
Right. And at the core of this is this fascinating and sometimes, well, precarious relationship between two economic giants with deeply intertwined strengths and vulnerabilities. You've got the U.S., a powerhouse in services, home to those dominant tech companies we all use with incredibly deep financial markets, and of course, the global reserve currency, the dollar.
The bedrock, really.
Then you have China, this colossal industrial engine holding massive reserves of foreign currency and with an economy very much directed, by the state.
What's particularly interesting is this mutual dependence.
Mm,
I mean, think about the device you're likely using to listen to this. It probably contains components made in China.
almost certainly.
In fact, around 13.5% of all U.S. imports this year are high-tech goods coming from China. Conversely, China holds a substantial amount of U.S. debt, about $760 billion in U.S. Treasury bonds.
And that reliance goes both ways, doesn't it? Despite their incredible technological advancements, Chinese firms still need access to those really cutting-edge semiconductors from the U.S.
They absolutely do, for the most advanced stuff, yeah.
But then you flip it, and China essentially controls the global supply of rare earth minerals, which are indispensable for everything from our smartphones to advanced defense systems.
It's this intricate web of reliance.
Yeah. And something that really stood out to me is that China's economy, in terms of its overall size, is actually more reliant on trade than the U.S.'s.
That's a key point.
Plus, they've been actively reshaping their trade relationships. The Association of Southeast Asian Nations, or ASEAN, is now their largest trading partner, overtaking the U.S. just this year. That's quite a shift.
That shift towards ASEAN is definitely significant. It shows their strategic efforts to diversify their economic dependencies away from the United States.
Mm-hmm.
However, as we'll explore, this doesn't entirely shield them from the broader impacts of this trade conflict. What's worth considering, maybe first, are the initial justifications for this trade war, the stated reasons, the in-principle arguments, if you will.
Right. So the U.S. side, they've voiced concerns about protecting its domestic industries, sectors like steel and solar panel manufacturing, and aims to pressure China to reform some of its trade practices that are viewed as unfair. Things like IP theft, state subsidy.
Yeah, the structural issues.
Exactly. And from China's perspective, there's a clear drive to achieve greater self-sufficiency, particularly in critical technologies, and to strengthen its ties with other nations through initiatives like the Belt and Road and RCEP. That's the Regional Comprehensive Economic Partnership, right? That big trade deal.
Exactly, RCEP. Those are the articulated goals, the theoretical pros for each side.
Yeah.
However, when we look at the broad economic consensus, the reality is far less optimistic for both.
Yeah, that seems to be the overwhelming view.
The overwhelming view among economists is that, in practice, a trade war ultimately results in both countries experiencing net losses.
Mm-hmm.
Pretty much everyone agrees on that.
Absolutely. And we're already seeing the tangible effects, aren't we? I mean, tariffs essentially function as a tax on imported goods.
Right.
They raise costs for the companies that bring them in, and ultimately those increased costs get passed on to you, the consumer, in the form of higher prices.
It's almost inevitable.
Yeah, and one recent analysis we looked at forecasts that the U.S. tariffs scheduled for 2025 alone could increase consumer prices here by over 2% in the near term.
2% is significant.
And actually reduce U.S. GDP growth by nearly a full percentage point. That's a big hit.
And it's not just one isolated study making that claim. The International Monetary Fund, the IMF, they've been quite direct, stating that consumers in the U.S. and China are unequivocally losers when these kinds of tariffs are imposed and retaliated against.
Unequivocally losers. Strong words.
It directly diminishes their purchasing power. Simple as that.
And get this, Fitch Ratings released a report just this past April indicating that U.S. tariffs have pushed the average import tax rate in the U.S. to an astounding 22%.
22%.
That's the highest level it's been since way back in 1910. And their warning was quite stark. If this trend continues, we could be facing a recession.
A recession warning from Fitch, that's serious.
That's a really significant potential consequence.
It truly highlights that while there might be some perceived short-term advantages, maybe political ones, the overall macroeconomic impact is profoundly negative.
Okay, so let's delve deeper into those specific potential U.S. gains and, maybe more importantly, the very real risks that come with them.
Let's do that.
Okay, so in the short term, one could argue that the U.S. might see a slight reduction in its trade deficit because it's importing fewer goods from China. Maybe.
A potential slight reduction, yes.
The government also collects more revenue from these tariffs, that's true. And politically, well, it can be portrayed as protecting American jobs and industries.
That's often the political narrative. However, these seemingly positive short-term outcomes come with considerable drawbacks. As we've already touched on, higher input costs affect U.S. manufacturers and retailers.
Right, the costs for businesses go up.
And those increased expenses are inevitably transferred to you, the consumer, through higher prices at the checkout. It just happens. And we came across a particularly concerning example from Axios regarding China's potential retaliatory tariffs. They could be as high as 84% on U.S. agricultural products.
24%.
84. Their assessment was that this would be devastating for U.S. farmers who heavily rely on exports to the Chinese market.
Ouch, devastating. You can just imagine the impact on those farming communities facing massive oversupply and plummeting prices.
It's brutal for them.
And it's not just agriculture, right?
Yeah.
When China imposes tariffs on other U.S. goods, our exporters in various sectors also suffer.
Absolutely.
Looking at the broader economic picture, the IMF and Yale's Budget Lab are projecting that these new tariffs in 2025 could shave almost a full percentage point off U.S. GDP.
Almost 1%.
That's a substantial amount of potential economic growth just disappearing.
Beyond that immediate impact, in the medium term, the U.S. could experience slower investment as businesses become more cautious in this uncertain trade landscape. You just don't invest as much when things are up in the air.
Makes sense. Uncertainty kills investment.
Higher inflation is a tangible risk as import costs remain elevated, and we can anticipate ongoing disruptions to supply chains as companies attempt to find ways to circumvent the tariffs, which cost money and time.
Right, that whole scramble to reconfigure supply chains. And looking further into the future, a prolonged trade war could actually undermine the U.S.'s leading position in global technology if access to essential components is restricted, couldn't it?
That's a really serious long-term risk. Moreover, if our allies begin to perceive our trade policy as excessively nationalistic and, frankly, unreliable, it could even start to diminish the dollar's appeal as the world's primary reserve currency.
That's the big one, isn't it? The dollar's dominance.
That's a very significant long-term risk to consider.
It is indeed. Now let's shift our focus to China. They also have some potential short-term benefits that they might emphasize, or at least ways they can cushion the blow.
Right. It's conceivable that Beijing could use this situation to really foster a sense of national unity and strongly promote the idea of self-reliance, particularly in crucial technological sectors. Rallying around the flag, essentially.
Yeah, there's definitely a narrative being built around weathering these challenges and emerging stronger.
Precisely. Chinese officials have even spoken about being prepared to endure hardship to achieve these strategic goals. And in the immediate term, they do have certain buffers available, substantial foreign exchange reserves,
Huge reserves.
and the capacity to implement fiscal stimulus, which is essentially government spending aimed at boosting the economy. They can turn those taps on.
They've got levers they can pull.
They've also had some success in redirecting their exports to alternative markets, like Russia, the Middle East, and those Asian countries we mentioned earlier. For example, their imports of Russian oil saw a dramatic increase last year.
Right, shifting trade flows.
Additionally, they have tools like capital controls and fiscal stimulus at their disposal to try and maintain economic growth.
But those measures are primarily ways to cushion the impact, aren't they? I mean, they don't eliminate the underlying costs.
No, they mitigate, they don't eliminate. Chinese industries are facing some very real costs. I mean, those U.S. tariffs on soybeans, and remember, a large percentage of their soybean imports from the U.S., worth billions, are now taxed.
Yeah, that's a significant blow to their agricultural sector, or at least their food supply chain.
Absolutely.
Yeah.
And the loss of access to critical U.S. technology for Chinese companies poses a major obstacle to their technological development, especially at the high end.
Right, the semiconductor restrictions, for example.
Exactly. And while they are aggressively pursuing technological independence, this will necessitate massive investments in areas like semiconductors, software, and AI. It's hugely expensive.
And probably slower, right?
And it will likely result in a slower pace of progress and higher costs for consumers when it comes to accessing new technologies. Even in the medium term, the potential for what some analysts are calling extreme decoupling could significantly reduce global GDP, potentially by around 7%.
7%, that's enormous.
And that would disproportionately affect China, given the continued importance of exports to their economy, even with their domestic push.
And when we consider the long-term challenges for China, it's not solely about technology, is it? Their aging population and the high levels of debt within their financial system. Those are big structural issues.
Huge structural headwinds. They will also constrain their ability to absorb prolonged economic hardship. So while they might gain some short-term leverage or achieve certain political objectives domestically, the overall economic outlook of a sustained trade war appears quite unfavorable for them as well.
So it really seems like a lose-lose situation economically.
It does. And to truly grasp the tangible consequences, we need to examine how specific sectors are being affected. Let's maybe begin with technology, which, as we've already touched on, is a major area of contention.
Yes, the high-tech sector has definitely been right at the forefront of this friction. We've seen the U.S. increasingly impose export controls on Chinese tech companies targeting semiconductors, AI chips, even Huawei equipment.
It's been escalating. And China has responded with its own restrictions, particularly on the export of those critical rare earth minerals.
Right, turning the tables there.
And other materials essential for electronics manufacturing, like gallium and germanium. They started restricting those too.
So in the short term, this just creates chaos for supply chains, right?
Significant disruptions, yeah.
Yeah.
U.S. tech companies are facing higher prices for essential components or are having to completely redesign their products, reconfigure manufacturing. It's costly and complex.
Meanwhile, Chinese companies in sectors like telecoms and data centers are struggling to find reliable alternatives to U.S.-made chips, especially the advanced ones.
That's their bottleneck. We even saw China begin to restrict exports of materials like gallium and germanium, for which the U.S. previously relied on them as a primary source. It shows they have leverage points too.
And it's somewhat ironic, isn't it? Some U.S. analysts are cautioning that this aggressive push for tech decoupling could actually weaken U.S. leadership in the long run. Because in rapidly evolving fields like AI and 5G, international collaboration and the development of global standards are really crucial for innovation if you cut yourself off.
That's a very important point. You risk falling behind if you isolate too much. Looking ahead, the technology sector is likely heading towards a significant division, maybe even a bifurcation.
Two separate spheres.
Potentially.
Mm-hmm.
China is investing heavily in its own R&D.
Mm-hmm.
They already account for about a quarter of global R&D spending, and they are actively seeking tech partners outside the U.S. sphere, Russia, some European countries, Asian nations.
Hedging their bets.
Simultaneously, U.S. companies are investing in reshoring production through things like the Chip-U.S. Act, trying to boost domestic semiconductor manufacturing and research.
Right, bringing production home or to friendly shores.
And expanding their manufacturing in allied countries like Taiwan, South Korea, and within Europe.
And we're already witnessing these shifts in manufacturing, aren't we? India and Southeast Asia are becoming increasingly significant as alternative production hubs.
Definitely seen that shift.
Apple, for instance, has nearly doubled its iPhone production in India in just the past year, and projections indicate that India could be exporting a substantial portion, maybe 25–30%, of the world's iPhones within the next couple of years.
That's a massive shift in a short time.
Yeah.
It really appears that we could end up with these two largely separate technology ecosystems, each with its own distinct supply chains and sets of standards.
Which sounds incredibly inefficient.
And it comes at a cost for both sides. U.S. tech companies will lose access to China's enormous domestic market, which hits their bottom line.
And China's technological progress may be slower and certainly more expensive as they attempt to build self-sufficiently in all critical areas. It's a tough road.
Ultimately, the fragmentation of global technology standards and a potential slowdown in the pace of innovation will likely have negative consequences for everyone, for global progress.
Okay, let's turn our attention to the energy sector. It seems like that area might be somewhat more insulated from these trade tensions, maybe?
You're generally correct. It's moderately exposed compared to tech, because commodities like oil and natural gas are traded on global markets.
Fungible goods.
Exactly. And both the U.S. and China are significant players. The U.S. is a major producer but still imports some, while China is the world's largest importer of energy. So In the short term, a trade war doesn't typically have a dramatic impact on global oil prices because organizations like OPEC play such a dominant role.
OPEC still calls the shots on oil prices, mostly.
And if China were to impose tariffs on U.S. energy products, they could pretty easily procure those resources from other suppliers. They've already demonstrated this. Their imports of Russian oil surged significantly last year, filling the gap.
And the same logic applies to natural gas, right? China doesn't import a massive quantity of liquefied natural gas, LNG, from the U.S. anyway.
Relatively small amounts, yeah.
So they could relatively easily switch to suppliers like Australia, countries in the Middle East, or even Russia if necessary.
Exactly. So it appears China's energy security is fairly robust in this scenario. U.S. energy producers, though, would simply need to find alternative buyers, like Europe, which is already a significant consumer of U.S. LNG and looking for non-Russian sources.
So a reshuffling of buyers and sellers, but maybe not a fundamental crisis for the sector globally.
In the short term, likely not a crisis. However, when we consider the longer-term implications, this trade conflict could actually accelerate the transition towards cleaner energy sources in both countries.
Oh, interesting. How so?
Well, the U.S. might intensify its focus on achieving energy independence, maybe by boosting domestic fossil fuel production, or perhaps more likely now, by making even greater investments in renewable energy technologies.
National security through green energy.
And China is already aggressively pursuing renewable energy development and expanding its energy infrastructure, like that new oil pipeline from Russia, securing non-seaborne routes.
It's fascinating how these geopolitical tensions can shape long-term energy strategies. China's increasing reliance on Russia and the Middle East for its energy needs really strengthens those alliances outside the traditional Western framework.
It reinforces those ties, and the U.S. emphasis on clean energy could ultimately reduce its dependence on energy imports altogether, changing its geopolitical calculus too.
It represents a significant geopolitical shift driven partly by this trade dynamic. Now, let's discuss agriculture. This has been a particularly contentious area, hasn't it?
Oh, absolutely. A real flashpoint. Before these trade tensions escalated, China was a massive buyer of U.S. soybeans, accounting for, around 60% of our total exports.
A huge market.
60%. Incredible.
But the imposition of tariffs really changed the landscape. China began sourcing much more heavily from countries like Brazil instead.
Brazil stepped right in. While the U.S. continues to export some soybeans to China, it's often at a significantly lower price, essentially selling at a discount just to maintain some market presence. And other U.S. agricultural exports, like pork and dairy products, have been substantially affected by China's retaliatory tariffs.
So in the short term, U.S. farmers have faced significant surpluses and depressed prices. I remember the headlines.
And the government has had to allocate billions of dollars in subsidies simply to keep them afloat. Billions.
There's direct payments.
And that potential 84% tariff on U.S. agricultural goods that we mentioned earlier, that would, as Axios aptly put it, be devastating for American agriculture if it came to pass.
Just wiping out that market overnight.
Meanwhile, China has been actively securing alternative suppliers. Brazil, for example, experienced a record soybean harvest last year, which helped meet China's demand. They're diversifying their sources rapidly.
So looking ahead, it sounds like this trade war could permanently alter the global agricultural trade network. It might not snap back.
It's looking increasingly likely. U.S. farmers might need to aggressively focus on identifying new export markets, diversifying away from China dependency.
And could we potentially see higher food prices here at home due to reduced competition or shifted trade patterns?
It's possible, yes. Less
Yeah.
efficiency in the system could mean higher costs. And China is also strongly pursuing food self-sufficiency policies
A big push for them.
and establishing agricultural agreements through its Belt and Road Initiative to lessen its reliance on the U.S. specifically.
So again, it sounds like both countries ultimately experience negative consequences in the long run.
It seems that way. Consumers face higher prices for food potentially, and farmers grapple with considerable uncertainty in lost markets. Even if relations improve in the future, those established trade patterns are likely to be permanently changed.
Yeah, South American soybeans might just have a stronger foothold in the Chinese market now, for good.
And U.S. cork, for example, might find its new primary markets in places like Canada, Mexico, and Japan, rather than relying so heavily on China again. A permanent realignment.
Now, a really significant underlying question in all of this is the impact on the U.S. dollar. It's been the dominant global currency for such a long time. What happens there?
That's a huge question. In the short term, interestingly, periods of heightened global uncertainty often actually strengthen the dollar.
The safe haven effect.
Exactly. Investors flock to perceive safety. The U.S. can still demand payment in dollars for a large portion of its international trade, and while China is actively promoting the use of its currency, the yuan, the dollar still overwhelmingly dominates global trade finance and foreign exchange reserves.
Still king for now.
Even though some countries are becoming somewhat wary of the dollar due to the U.S.'s use of sanctions and its trade policies, there aren't yet any truly viable large-scale alternatives to replace it globally.
But you can see how a sustained trade conflict, this kind of economic nationalism, could gradually erode that dominance over time, right? It chips away at trust.
Absolutely. It raises questions. China and its trading partners have already started increasing their use of local currencies in their bilateral trade. We're seeing more of that.
Avoiding the dollar altogether where possible.
The IMF has observed a notable increase in the use of the renminbi, or RMB, that's the official name of the Chinese currency, in trade finance related to China. And a significant percentage, maybe around half now, of China's cross-border payments are being conducted in yuan.
Half. That's substantial progress for them.
It is. If this trade war intensifies, it's highly likely that China will push even more aggressively for yuan-based settlements with countries that are politically aligned with them, like Russia or nations in the Belt and Road Initiative,
And they'll push that digital yuan too, presumably.
and further expand the adoption of its digital yuan, yes, trying to build an alternative financial infrastructure.
So could we be looking at a future where the dollar isn't quite as all-powerful as it has been, maybe a more fragmented system?
Over the longer term, perhaps within the next 5 to 10 years, we could certainly see a more multipolar currency system emerge.
Multipolar.
The dollar will likely remain a crucial currency, probably the most important one, but others, like the euro, yen, yuan, and maybe even gold, could play more prominent roles within different economic blocs or for specific types of transactions.
Different spheres of influence for currencies.
Exactly. The IMF has cautioned about the risks associated with this kind of monetary fragmentation, potentially leading to increased volatility in exchange rates and higher transaction costs for international trade. It makes everything more complicated.
More friction in the system.
While no other currency is likely to completely replace the dollar in the near future, the U.S.'s geopolitical standing and its commitment to open trade policies will be critical in maintaining the dollar's long-term strength. A protracted and acrimonious trade war could certainly damage that crucial trust.
It really highlights just how interconnected everything is, doesn't it? The trade policy affects the currency's global standing. And this trade war isn't just affecting the U.S. and China directly, is it? There are significant ripple effects being felt around the world.
Absolutely. No one escapes entirely. Let's consider Europe first. The European Union has deep economic ties with both the U.S. and China. Huge ties.
Yeah, they're caught right in the middle.
China is their largest source of imports and a massive market for European goods, particularly high-value items like German cars, French luxury goods, machinery.
Right.
In the short term, Europe could face collateral damage. Tariffs on Chinese raw materials or intermediate goods could potentially increase costs for European manufacturers who rely on those inputs.
Supply chain pain for them, too.
On the other hand, some European companies might see an opportunity to gain market share in the U.S. if Chinese goods become more expensive there, or maybe bring more of their production closer to home within the EU.
Politically, it sounds like the EU is trying to navigate a really delicate situation, right? They have their own trade disputes with the U.S. sometimes, and they generally prefer multilateral solutions.
Exactly. They're pushing for de-escalation, for using the WTO. Longer term, the EU might try to diversify its economic relationships, increase trade within the European Union itself, pursue more trade agreements in Asia,
The hedging strategy.
and perhaps even finding areas of cooperation with China just to maintain access to those important markets, keep channels open.
But there's a risk if the world splits into blocks, right?
Yes, the risk is that fragmented global trade rules will slow down overall economic growth. Studies have indicated that even wealthy regions like the EU could experience substantial export losses in a deeply divided global economy, maybe a 2% hit to global output in a two-block scenario.
What about India? We touched on them earlier. They seem to be in a potentially very advantageous position in all of this.
India certainly has the potential to be a significant beneficiary.
Right.
They're being actively courted by the U.S. as a strategic partner, part of the Indo-Pacific strategy.
Right, the Quad and all that.
And businesses are increasingly looking at India as a viable alternative manufacturing location to China, the China Plus One strategy.
We mentioned Apple already.
Yes, we've already seen that substantial increase in iPhone assembly in India, and numerous other companies in sectors like electronics, automotive, pharmaceuticals are expanding operations there to mitigate the impact of tariffs and geopolitical risk.
So short-term, stronger U.S.-India ties.
Likely see even stronger trade and technology ties between the U.S. and India. That should boost Indian exports and attract greater foreign investment. They've also benefited from shifts in global commodity markets, becoming a top buyer of discounted Russian oil, for instance.
Playing all sides a bit there. But they also have to be careful not to provoke China in the process, don't they? They share a border and relations are tense.
Absolutely. That's the balancing act for India. There's always a risk of potential countermeasures from China. However, if this trend of decoupling between the U.S. and China continues, India could indeed emerge as a major global manufacturing hub and a crucial strategic partner for the United States.
Which could have big implications for immigration, talent flows.
Significant implications for immigration patterns and the international flow of skilled labor, yes.
And what about Southeast Asia? Countries like Vietnam, Thailand, Malaysia, they've been frequently mentioned as alternative manufacturing destinations too.
Yes, the ASEAN economies are already playing a significant role as alternative manufacturing bases. We saw a notable shift in supply chains towards this region during previous periods of U.S.-China trade tension.
They absorbed some of that initial relocation.
In the short term, they are seeing increased opportunities to attract foreign direct investment as companies look for alternatives. And as we noted earlier, ASEAN as a bloc has now become China's largest trading partner.
So they benefit from China's diversification too.
Longer term, we will likely see more nearshoring or friendshoring of production to this region. While they do face some complexities in navigating the differing regulations and demands of both the U.S. and China,
It's not easy being in the middle.
the overall impact is likely to be net positive for many ASEAN economies due to increased economic engagement and investment from both global powers.
Okay, Australia has a somewhat complex situation. Firm security ally of the U.S., but China is its largest trading partner by far.
Exactly. A classic dilemma. They have already experienced China imposing trade restrictions on things like wine and barley for perceived political slights.
Yeah, economic coercion.
A renewed intensification of the U.S.-China trade war could deepen that dilemma. In the short term, they risk further economic retaliation from China if they fully align with U.S. technology restrictions, like the Huawei ban they implemented early on.
But they might gain elsewhere.
However, they might see some benefits if China shifts its sourcing of certain commodities away from, say, the U.S. and towards Australia, maybe in resources. It's complicated.
And long term.
Longer term, they will likely align more closely with U.S.-led supply chain initiatives, particularly in critical minerals and technology. But losing significant access to that massive Chinese market would be a significant economic blow for their exporters, particularly agriculture and resources. It's painful.
And Canada, being the U.S.'s closest neighbor and a major trading partner, is almost certainly going to be affected by all of this, aren't they?
Unfortunately, yes. They often get caught in the crossfire. They have already implemented some tariffs on Chinese goods like EVs and steel recently, mirroring U.S. moves,
Following the U.S. lead.
and faced retaliatory measures from China on their agricultural products like canola. China is a significant trading partner for Canada, second largest, I believe.
So any worsening of U.S.-China relations hits them hard.
It's likely to have negative consequences for Canadian farmers and potentially their technology and natural resource sectors as well. They don't really have much incentive or perhaps ability to diverge significantly from U.S. policy on major issues like this.
Geopolitically locked in.
But they definitely stand to lose trade with China as a result of these broader global tensions. It's a tough spot for them.
So it really sounds like on a global scale, there are no true winners in this trade war. Just varying degrees of losses, disruption, and a pervasive sense of economic uncertainty.
That seems to be the consensus. And the potential for a significant contraction in global GDP, if these tensions escalate dramatically, that 7% figure or even the lower 2% IMF estimate is quite concerning for global prosperity.
It is. And that potential for fragmentation could lead to countries and businesses trying to maintain connections with both major powers. But that middle ground is going to become increasingly difficult, maybe impossible to navigate.
Very narrow. We might see the development of more distinct trade and currency blocks, which could partially compensate for lost trade flows, but likely at higher costs and with increased friction and inefficiency.
And we shouldn't forget the impact on poor countries,
Yeah,
right?
absolutely crucial. Lower-income exporting nations could be particularly vulnerable if global demand weakens and commodity markets experience a downturn as a result of all this uncertainty and fragmentation. They often suffer the most.
Beyond the broad economic and geopolitical consequences, this trade war also has a very significant human dimension, particularly when we consider diaspora communities and international immigration patterns. That's often overlooked.
Absolutely, it's a critical piece. For the large Chinese diaspora residing in the United States, over 5 million people,
It's a huge community.
the heightened tensions can lead to increased suspicion, profiling, and a general sense of unease. Proposed legislative measures, like visa restrictions or scrutiny of research ties, have created anxiety among Chinese students and researchers.
And business investment has plummeted too.
Chinese business investment in the U.S. has seen a dramatic decline since the trade war began. There's a genuine feeling of being caught in the middle, potentially facing prejudice for many Chinese Americans.
So, what are the potential medium-term effects?
Well, we could see a decrease in the number of new Chinese immigrants coming to the U.S. and a chilling effect on Chinese American entrepreneurs starting businesses. In the longer term, if relations remain strained, we might even see more skilled Chinese professionals choosing to return to China, the reverse brain drain, or seeking opportunities in other countries.
And just increased social pressure within the U.S.-Chinese community.
Definitely a risk. On the other hand, the substantial Indian diaspora in the U.S., another very large group, might see some advantages, with the U.S. potentially becoming more reliant on Indian talent as relations with China become more strained.
Right, as one door closes, another might open.
Potentially.
Hmm.
With closer trade and security cooperation between the U.S. and India, Indian professionals in the IT and engineering sectors in the U.S. could see expanded job opportunities.
And maybe more demand for students.
And there might be greater demand for Indian students at U.S. universities, who already form the largest group of international students. Over the coming years, we could even see some adjustments to U.S. immigration policies that favor individuals from allied nations like India, potentially leading to increased immigration flows from that region.
It's fascinating how these large-scale geopolitical shifts can influence international migration patterns so directly. And it's not just the Chinese and Indian diasporas, is it? There could be broader impacts.
That's a valid concern. There's a risk of increased stereotyping or prejudice against individuals of Chinese or even other East Asian ethnicities in Western countries due to the heightened geopolitical rivalry.
And fewer Western students going to China?
We might also see a decrease in the number of Western students choosing to study in China if tensions remain high. Simultaneously, China's efforts to attract overseas Chinese talent, particularly in science and tech, to return home could intensify.
So overall, we might see a kind of partitioning of skilled migration flows.
Possibly a form of economic partitioning and skilled migration, with Chinese graduates increasingly looking towards China or other non-aligned economies for opportunities, while the U.S. and its allies rely more heavily on talent from India, Southeast Asia, and other parts of the world.
So as we conclude this deep dive, the core message really seems to be that the U.S.-China trade war is an incredibly intricate issue. And despite any perceived short-term benefits, either side might claim political cover, maybe some revenue.
Right, the narrow games.
The long-term implications appear overwhelmingly negative for both nations and really the global economy as a whole. It's a very difficult trade-off between pursuing self-reliance or perceived security and the significant damage it inflicts on global efficiency and international cooperation.
Exactly. We've explored how this conflict is likely to affect, well, almost everything. From the prices you pay for everyday goods to the transformation of global manufacturing landscapes where your phone gets made,
Yeah.
and even the evolving dynamics of global power and the future of the U.S. dollar.
And the potential shifts in immigration patterns, human cost, underscore the deeply personal consequences of these large-scale economic and political forces.
Absolutely. It's not just abstract economics.
It really prompts you to consider, given the profound interconnectedness of the global economy that we've discussed, whether true decoupling is even a realistic or desirable objective in the long run. Is it even possible?
That's the fundamental question, isn't it?
And what innovative solutions might exist beyond the current trajectory of conflict and escalating tariffs? It's definitely something to continue contemplating long after this discussion ends.